Hi everyone, welcome to BISP Solutions. My name is Abdullah Khan, and today we are going to discuss configurable consolidation. And the rule that we are going to discuss today is dividend declared by subsidiary adjustment rule under FCCS. So for that, we'll take a look at the use case that we have prepared for this scenario. So in this scenario, we have a subsidiary by the name of C602 and a holding by the name of C601. And the ownership percentage that the holding has over subsidiary is 80%. So during the year, at any time during the year, the subsidiary may declare some of the amounts of its profits as dividend that needs to be paid to the subsidiary and NCI as well. That needs to be paid to the holding, sorry, and the non-controlling interest, that is the minority interest as well. So in our use case, the amount of dividend that has been declared by the subsidiary is say 5,000 USD. So for that, the subsidiary would pass the following journals in their ERP system. So the entries that would be passed there would be dividend declared debited, dividends payable credited, and when the same is paid, the dividends payable would be debited and the bank account would be credited. So the net effect in the subsidiaries books of accounts would be say under the equity side, the dividends declared amount would get debited, that is a negative of 5,000. And since we are not taking any of the cash balances or the bank balances right now in our use case, so we'll take it in the later case. But right now we are just assuming that we had a zero balance, so it goes to negative. We say we are taking a loan and then paying it, so a negative of 5,000. Then in the books of holding, which will receive the amount of dividend and receive it in their ratio of their ownership, as per the ratio of their ownership, because they have an ownership of 80% over the subsidiary. So the dividend that the holding will receive is 5,000 into 80%, which is 4,000. So the journals that will be passed in the books of holding would be an asset debited, that is the dividends receivable, to dividends income, and when the same amount is received, they will debit the bank account and credit the dividend receivable account. So this account of dividend receivable also gets nullified here. In the same way, the dividends payable account had been nullified here by crediting and then debiting the same subsequently. So the net effect that would be there in the books of the holding would be a bank positive, that is a bank debit of 4,000, which is received through dividend income. So the dividend income would be a part of the retained earnings of the holding. And when we will consolidate, so under consolidation, since the dividend income is not an intercompany transaction, it is a normal income which is earned due to the investments made by the holding in the subsidiary. So we'll have to record the same entries that are recorded in the holding, which is bank debited and dividend income credited. The dividend receivable account would be debited and credited and would get nullified. So the full case scenario for these entries is shown in another spreadsheet. So we'll just go to that spreadsheet and see what is the exact case scenario there. So those in the last spreadsheet, we saw the effect or the impact of the entries related to only dividend accounts. Now we'll take a whole balance sheet for the holding, which is C601, and the subsidiary, C602, over which we have an 80% control, 80% ownership. And the final output we'll see through consolidation by running the consolidation business rule from the application. So in our case, we have a machinery of 50,000 for holding and a 10,000 machinery for subsidiary. We have an investment which is 50,000. This is the investment amount of 50,000 which the holding has in the subsidiary. Then we have a short-term receivables of 30,000 in the holding, 20,000 in the subsidiary. Then we have a 44,000 bank balance in the holding. So I have assumed that 4,000 of the dividend received from the subsidiary is included in the bank account. So say in case my bank had a balance of 40,000 before receiving the dividend, and then it received a dividend of 4,000. So the total now gets to 44,000 of cash or bank. So the total of my assets is 174. Then we have and correspondingly, uh, the bank account of subsidiary, say was 10,000 earlier, and now after payment of 5,000, because it has paid to both the NCI as well as the holding. So say 4,000 is paid to the holding and 1,000 is paid to the NCI, which will be shown in their respective bank accounts. It's not shown in the consolidation. It is shown under the respective bank accounts of NCI. That maybe NCI may be any individual, so it will reflect in the bank account of an individual in case an NCI is an individual. So this 1,000 does not bother us. The thing is that 4,000 will be received by the holding, and but the whole of the 5,000 will be paid by the subsidiary through their bank account. So assuming that they had a balance of 10,000 before the payment of such dividend, after the payment of 5,000 of dividend, the net balance of bank account would be 5,000 in the books of subsidiary. Then the common stock is 60,000 for holding, 25,000 for the subsidiary. We are receiving the return on the common stock of the subsidiary through our investments. So that's not an issue. Then the retained earnings, we are assuming for holding, the revenue minus COGS is 50,000 plus 4,000 of the dividend income that we will be receiving from the subsidiary. So in my case, we can assume that we have a revenue of 70,000, then we have a COGS, that is the cost of goods sold, of 20,000. So the net income would be 50,000. Adding, then we will add the dividend income that is received from the subsidiary of 4,000. So the retained earnings figure at the close would be 54,000 under the holding entity. Then for subsidiary, we have assumed that revenue minus COGS is 15,000. Thereafter, we have paid the dividends. So the dividend declared is an adjustment from the retained earnings. So I can just show this to you through the hierarchy in our account dimension as well, that the dividend declared is a child of the retained earnings hierarchy under the account dimension. So we'll just search the dividend declared account. See, the dividend declared account is the child of retained earnings. So if we open the retained earnings, we can see the dividend declared account. However, the account type for this dividend declared as per the application, which is predefined, is an asset type account, and the plan type under console is subtraction. So ideally, it should subtract this 5,000 that we have input under the dividend declared while calculating the retained earnings under C602. That is our subsidiary. So we'll check this whether the 5,000 is getting eliminated or not under the C602 entity while we are rolling up the data. Not while consolidating. Under consolidation, we'll see a different result for C600, but we'll try to see the individual data first, and then we'll see the result of consolidation. So ideally, it should eliminate 5,000, which is part of the retained earnings, and it is subtracting. So my net retained earnings should be 15,000 minus 5,000, which is 10,000. And the total of liabilities should be 35,000 here and 174 for holding. Now, one or two things that we can see now, the goodwill calculation. So investment in subsidiary was 50,000. The net assets, we are taking 80% of 25,000, which is the common stock of the subsidiary. So my net goodwill should be 30,000, while consolidation. The NCI should be 20% of 25,000, which is 5,000. Then we have the profits earned by the subsidiary. So that would be included. So the profits that are earned would be 10,000, 15,000 minus 5,000. 10,000 is the profit which is earned by the subsidiary, and 20% is the share of NCI. So ideally, the minority interest should be 7,000. Then we have the retained earnings of the holding. So 54,000 is the retained earnings of the holding. And while calculating the consolidated retained earnings, we'll calculate our share. So our share is 8,000, that is 15 minus 5, 10,000 into 80%, 8,000. So the consolidated retained earnings should be 62,000. So our consolidated financial statements should show these results that are there in our use case. So ideally, what should happen is that 50,000 plus 10,000 should be the figure of machinery and equipment under consolidated financial statements. Then there should be elimination of the investment in subsidiary. There should be goodwill of 30,000. Short-term receivable will be simply added and rolled up with the figure of 50,000. Then we have a bank account 49,000, 5 plus 44. So the total of assets should be 189. Correspondingly, the common stock of the holding should only be taken, which is 60,000. The retained earnings should be 62,000 as calculated in our workings here. Then NCI or minority interest should be 7,000 as per our workings. Short-term payables are there only in the case of holding, so they will be rolled up as it is, and the total of the balance sheet should tally with 189. So this should be the ideal scenario when we run the consolidation in our application in the case of dividend declaration and payment by the subsidiary. So for this, we have created the smart view already and input the data as per our use case. So we'll just map the data whether it is as mentioned under the use case. So I'll open both of them side by side. So we have machinery of 50K and 10K under holding and subsidiary respectively. So that is fine. Then we have short-term receivables of 30 and 20. So it should be 30 and 20 here. It's fine as well. Then we should have a BNK checking account, bank account 44 and 5, which is also correct. Then the other accounts include common stock of 60 and 25. So here is 60 and 25. Then there should be a short-term payable of 60,000 in the holding. Here is the short-term payable. Then there should be a retained earnings of 50,000 plus 4,000 is the dividend income that we have. So 70 minus 20 is 50, 50 plus 4 is 54. So 54 should be our retained earnings under the case of holding. So I'll just create another retained earnings account as well so that we can easily relate to it. And can keep the same movement, total movements. See, the retained earnings account is 54,000, which is the same as in our use case. So that is also correct. For subsidiary, it should be 10,000, 15 minus 5, which is also correct. So that means that it has adjusted or subtracted the dividend declared while calculating the retained earnings, since the properties that were defined under the console type was subtraction. So it has clearly subtracted the dividend declared, since we have taken the revenue as 35 and the COGS as 20. So the net effect is 15, and then it has subtracted 5,000 as well. So 15 minus 5 is 10,000. So our retained earnings is also mapping as per our use case. And yeah, so all of the accounts we have taken here, including the dividend income. So we'll take the dividend income of 4,000, and then all the assets and the liabilities are the same as we have taken in our use case. The total of the assets is 124 here, and the investments is 50 here, which we have taken as an intercompany transaction. So 50 plus 124 is 174. And the liabilities is also 174, which was also the case in our example. And 35 and 35 is the total of assets and liabilities in the subsidiary company. So now we just need to run consolidation, and we can hope that our result, which we require, comes to the same conclusion as we have concluded in our use case. So ideally, our assets total should be 189, the goodwill should be 30,000, minority should be 7,000. So all these, the retained earnings should be 62. So Ideally, when we run the consolidation, the results should be the same as per our use case. So we'll try to run console through our application. We'll go to the application. Under application, we'll go to rules and run the consolidation rule. C600 is our entity. All of it is fine. We'll just launch it. Now we'll check what results are produced by the consolidation rule. So I'll just go to my output sheet. I'll click on refresh. So the results that we are hoping for, uh, in case they get mapped to our use case, then all is fine. Then we don't need to do anything. No configurable consolidation is needed. However, if there is any difference, then we'll see whether any rule needs to be deployed through configurable consolidation. So first of all, we can see that 60,000 is the machinery and equipment in our use case. Under consolidation, 60,000 is the result of machinery and equipment, which is fine. This is okay. Then 30,000 is the goodwill. So we come to goodwill in some time. Short-term receivables is 50,000. So short-term receivables is 50,000. That's okay. Bank account is 49,000. So here also bank account is 49. Common stock is 60,000. So that is also fine. 60,000 here. Then we have what we have. We'll see goodwill later. Short-term payables is 60,000. So short-term payables is also okay. There's no adjustment needed here. That is also fine. Then we have three remaining accounts, that one of them being minority interest, retained earnings, and goodwill. So these three needs to be checked. Check. So first of all, we'll go to the retained earnings account. So retained earnings account is showing a balance of 66,000. However, ideally, it should showcase a balance of 62,000 as per our workings. So why is that so? So the only reason for that is the account of dividend declared. So what is happening here is that when we are running the consolidation business rule, the dividend declared account is not rolling up to the console entity, console level, that is C600. It got rolled up when we prepared the input sheet. It got rolled up and it got subtracted from under the retained earnings and showed us the results after getting rolled up only. However, when we are running the rule of consolidation, what is happening is that it is not rolling up the 5,000. So ideally, it should have rolled up the 5,000 here, and then we would have gotten the results that is desired. We would have gotten the retained earnings of the subsidiary as 10,000, 15 minus 5, 10, and then the ratio of 80/20, the retained earnings would have been shared in that ratio. However, now what is happening is that the retained earnings that are getting shared among the holding and the NCI is 12,000 for the holding, which is 15,000 into 80%. So 12,000 of subsidy is getting rolled up, and that's why an excess of 4,000. Earlier, ideally it should have been 8,000, but it's now getting rolled up as 12,000. So the difference of 4,000 is in excess is getting rolled up to the retained earnings. So ideally my retained earnings should be 62, but it is getting rolled up as 66. So it is not rolling up the dividend declared account when we are running the consolidation at the consolidated entity level. And we can also see what it is doing if we take the dimension of consolidation as elimination for C602. So C602 is the entity which has declared the dividend. And when we run the intersection of elimination under the consolidation dimension, what we see is that the dividend declared is automatically getting eliminated without any configurable consolidation rule being deployed. It is getting eliminated. So one of the reasons that this is getting eliminated could be a standard elimination is already set under the application for the same. So if we go to consolidated, there are certain standard eliminations for which are defined in the application. So it may be a case that it is getting standard eliminated when we are running consolidation. So and this is hampering our use case. So what it is doing is that we are getting a double dividend of sorts. We are getting a 4,000 in excess. Our dividend income is correctly getting rolled up, so we have a dividend income of 4,000, but we are getting a double dividend effect because the same of 5,000 is not getting rolled up to the holding or to the C level. So we are getting another 4,000 impact, which is increasing our retained earnings by 4,000, which ideally should have been 62, but now it is showing a balance of 66,000 in our retained earnings. So we will prepare a configurable consolidation rule which eliminates or adjusts our share of 4,000 of the dividend declared when the C level entity gets rolled up, when the consolidation rule runs. So one adjustment is needed here. And the other adjustment, so first we'll check the minority. Minority is fine. Minority does not get, the minority is 7,000. So minority is okay because minority is not getting impacted by the retained earnings. Dividend is received in the accounts of the shareholders, the NCI shareholders, the non-controlling interest shareholders. They do not get rolled up in the books of the holding. So that balance of minority of 7,000 is fine. The only issue, the second effect of this adjustment is going under the goodwill account. So if you see, the balance of our goodwill should be 30,000 as per our use case. However, it is rolling up as 34,000 under goodwill offset account. So we need to adjust these amounts to get to our desired results, because this is ideally not the case scenario that we need. We need to adjust the amount of dividend which has already been booked as income by the holding. So in order to nullify the impact, in order to reduce the double effect that is being showcased when we are running the consolidation, we have prepared a rule, a business rule, or a configurable consolidation rule for dividend adjustment. So if we go to configurable consolidation in our application, the rule for the same, which is currently undeployed, is created by the name of dividend declared by subsidiary adjustment in holding. So there are two rules under this rule set. So the first rule is the dividend which is declared would be adjusted to the dividend income of holding. So the holding's share of dividend income from subsidiary is 80% of what the subsidiary is declaring, right? So for this to happen, we have provided the condition as entity current method equals to subsidiary, because we only need to adjust the dividends which are declared by subsidiary and not the dividends which are declared by any other company. So we have to adjust the dividends which are declared by subsidiary. So we have taken the condition for subsidiary. Then for factor, we have taken under current as entity ownership percentage, which in our case is 80%. So whatever 5,000 in our example, if we assume 5,000 is declared as dividend, so 80% of 5,000, which is 4,000, should be adjusted from dividend declared when we run the consolidation. So under C600, we should get a dividend declared amount of 4,000 rolled up when we run this rule. So we have taken the factor of entity ownership percentage, which will roll up the 80% of 5,000. Processing option is add. Then these are the scenarios for the console level. The account from which I want to make the adjustments is the dividends declared account. So right now, dividends declared is already showing a negative of 5,000 under the eliminations. If you can see, the dividends declared is already showing a negative of 5,000. So I want to create such a rule that the dividend declared gets shown up as 4,000 in the C level under C600. So for that to happen, I will have to make an elimination I will have to make this negative 5,000 adjusted by 80% so that the elimination amount is just 1,000 minus of 1,000, and rest of 4,000 gets rolled up here. So for that, 5,000, 80% of 5,000, 4,000, we'll add 4,000 to a negative of 5,000. So my negative net amount will remain as minus 1,000. And then my dividend declared can get rolled up as 4,000 at my C level. So I've selected my account as dividends declared, intercompany is no intercompany, movements is the dividend payment to stockholder movements. So this is the movement which I have taken while inputting my data. And data sources, data input. Whereas the targets are all the same. So since I want to adjust, I want to make an adjustment in the dividends declared account itself. So I have taken the target account, same as source. Then the next adjustment that we ought to make in this case is the goodwill increased, which was increased to 34,000. Ideally, it should have been 30,000. It is increased. So I need to adjust my dividend declared, my goodwill offset, sorry, with the amount of the dividend declared by the subsidiary and 80% of the same, which is the ownership percentage. So again, I have taken the entity ownership percentage as my factor, and the current processing option this time is subtract because the account types are same. So an asset is getting subtracted from an asset. So I have taken the processing option as subtract. The only difference here is that the account, which is the target redirection account now, is the goodwill offset account. So what will this rule do is that it will adjust my 4,000 with the goodwill offset account and throw me a result of 30,000 under the goodwill offset account. So I'll just deploy the rule and again run consolidation. For deploying, I'll just check the box here and then click on deploy. And then I'll go back to the business rules and run consolidation to see if my result maps this time with the use case scenario. I'll go to rules, run console. I'll just refresh it again. Just check whether the rule is deployed or not. Just POVs are fine. I'll click on launch again. Okay. The case of dirty ownership, so I'll have to validate my or recompute my ownership data again. Let's go to consolidation and again recompute. Okay, the scenario is planned. Recomputation is successful. I'll save my changes. Ownership data saved. Again, I'll try to run console and see the output. multiple users are running consolidation right now, so that's why this error. All the POVs are fine. I'll just run it again. Go back to my output sheet, try to refresh. So now you can see that my goodwill amount is getting eliminated by 4,000, and the net goodwill under goodwill offset is 30,000. So that was what we needed in our use case. If you can see here, we needed a goodwill of 30,000. So it's now okay after the rule getting deployed. Another adjustment that we needed was under dividends declared. So you can see the dividends declared account is throwing up the figure of 4,000 under the console level, that is C600, after the rule is deployed. And what is happening is that under elimination, if you can see, uh, only negative of 1,000 is now getting eliminated, which was desired by us, so that the retained earnings figure is now equivalent, which was there in our use case scenario. So that is the ideal case that should have been there from the beginning. But since the application was not rolling up the dividends declared account under the console level, it was throwing a standard elimination. So we have adjusted the standard elimination with our configurable consolidation rule, and we have gotten the ideal result that we needed. So the total of assets and liabilities is also mapped with 189 and 189 respectively, which was there in our use case as well. You can see okay and okay. So this was another case of configurable consolidation. In case you have any queries, you can connect with us. Thanks and have a great day ahead.